Welcome to this CA Final Law Masterclass on the procedural, reporting, and regulatory aspects of external commercial borrowings, commonly known as ECBs. In practice and in examinations, students often focus on borrowing limits and eligible borrowers, but equally important are the compliance requirements that follow after raising an ECB. In this session, we will understand how ECB proceeds are parked, the procedure for raising ECBs, mandatory reporting requirements, treatment of untraceable entities, powers delegated to AD Category I banks, conversion of ECB into equity, security creation, and special provisions applicable to public sector oil marketing companies. To understand ECB compliance systematically, divide the framework into 4 pillars. First is the procedure for raising ECB through the automatic or approval route. Second is reporting, which includes obtaining a loan registration number and filing Form ECB-2. Third is regulation, covering parking of funds and the special framework for untraceable entities. Fourth is security, including charges on assets, guarantees, refinancing, and conversion of ECB into equity. If you remember these 4 pillars, the entire procedural chapter becomes easier to revise and reproduce in the examination. ECBs can be raised through either the automatic route or the approval route. Under the automatic route, eligible entities that satisfy prescribed ECB parameters can approach an AD Category I bank with a duly completed Form ECB. No separate RBI approval is required. Under the approval route, the borrower submits Form ECB through the AD bank to RBI. RBI evaluates the proposal based on ECB guidelines, macroeconomic conditions, and the merits of the specific transaction. Large proposals beyond prescribed thresholds may also be placed before an empowered committee, after which RBI takes the final decision. A borrower cannot draw down ECB funds unless a loan registration number, or LRN, has been obtained from RBI. The process begins when the borrower submits a certified Form ECB in duplicate to the AD Category I bank. The AD bank forwards one copy to RBI's Department of Statistics and Information Management, known as DSIM. Interestingly, RBI does not require a copy of the actual loan agreement. Once the LRN is issued, the borrower becomes eligible to draw down the ECB. Also remember an important exam point. Any change in terms and conditions must be reported through a revised Form ECB within 7 days. Obtaining the ECB is only the beginning. Continuous reporting is equally important. Every borrower must submit Form ECB-2 on a monthly basis through the AD Category I bank. The return must reach RBI's DSIM within 7 working days from the end of the relevant month. Any modification in ECB parameters must also be reflected in this return. If reporting requirements are delayed, including delays in reporting drawdowns or filing Form ECB and ECB-2 returns, the borrower may regularize the default by paying a late submission fee, provided all other ECB guidelines are complied with. The ECB compliance process follows a logical sequence. First, the borrower submits Form ECB, either through the automatic route or approval route. Second, the AD bank forwards the form to RBI's DSIM for generation of the loan registration number. Third, after receiving the LRN, the borrower can draw down the funds. Fourth, monthly reporting through Form ECB-2 becomes mandatory within 7 working days of month end. Finally, if any repayment terms, maturity conditions, or other ECB parameters change through mutual agreement, a revised Form ECB must be submitted within 7 days of such changes becoming effective. The treatment of ECB proceeds depends upon their intended use. If the funds are meant for foreign currency expenditure, they may be parked abroad until utilization. Such funds can be invested in highly rated deposits, certificates of deposit, treasury bills, and similar liquid instruments, generally requiring minimum ratings such as AA- or AA3. On the other hand, ECB proceeds intended for rupee expenditure must be immediately repatriated to India and credited to rupee accounts maintained with AD Category I banks. These funds may be parked in unencumbered term deposits for a maximum cumulative period of 12 months. RBI prescribes a special framework for entities that effectively disappear from regulatory oversight. An entity may be classified as untraceable if it remains unreachable or unresponsive through emails, letters, or phone communications for at least 2 quarters, despite 6 or more documented reminders. However, this alone is not sufficient. 2 additional conditions must also be satisfied. First, the entity must be found inoperative at its registered office or during official verification. Second, it must have failed to submit the statutory auditor's certificate for 2 years or more. Only then can the untraceable status be invoked. Once an entity is designated as untraceable, AD Category I banks must follow a strict procedure. Revised Form ECB and the last Form ECB2 return are filed without company certification and clearly marked as untraceable entity in bold. The outstanding ECB amount is written off from India's external debt liability records, although lenders may continue recovery efforts. No fresh ECB applications from the entity are processed. Additionally, inward remittances and debt servicing under the automatic route are not permitted. Most importantly, the Directorate of Enforcement must be informed about the designation. Think of the identification process as a 4-step verification mechanism. The process generally begins when reporting contraventions continue for 8 quarters or more. Next, evidence is gathered showing repeated communication failures, including at least 6 reminders over 2 quarters. Thereafter, physical verification confirms that the entity is not operating from its registered office. Finally, compliance records reveal that the statutory auditor's certificate has not been submitted for 2 or more years. When all these requirements are fulfilled, the entity is formally classified as untraceable, and regulatory restrictions immediately apply. RBI delegates several operational powers to AD Category I banks. They may approve a change of AD bank, subject to obtaining a no-objection certificate from the existing AD bank. They can also request cancellation of an LRN if no drawdown has occurred and all ECB2 returns have been filed. Refinancing of an existing ECB is permitted if the maturity period is not reduced and the all-in cost of the fresh ECB is lower. Indian banks may participate in refinancing only in limited cases, particularly involving AAA-rated corporates and Maharatna or Navratna public sector undertakings. ECB can be converted into equity, including cases where the ECB has matured or remains unpaid, provided prescribed conditions are satisfied. The activity must fall under the automatic route for FDI or obtain government approval. Lender consent is mandatory, sectoral caps must not be breached, and pricing guidelines must be followed. For partial conversion, the converted portion is reported in Form FCGPR and disclosed in Form ECB2. For full conversion, the entire amount is reported through FCGPR, appropriate disclosure is made in ECB2, and further ECB2 filing is generally not required. ECB lenders may be provided security through charges on immovable or movable assets, subject to AD bank approval, appropriate loan documentation, and NOCs from existing domestic lenders. Any security must co-terminate with the underlying ECB. In the case of immovable property, overseas lenders cannot directly acquire property in India. Upon enforcement, the property may only be sold to a resident in India, and sale proceeds must be repatriated for ECB repayment. For movable assets, the lender's rights are limited to the outstanding ECB claim, and removal of assets generally requires lender approvals. Security for ECBs may also be created through financial securities. Borrower or promoter shares, shares of domestic associate companies, bonds, debentures, government securities, and mutual fund units may be pledged. Security interests can additionally be created over cash balances, loan assets, escrow accounts, and debt service reserve accounts. Any invocation must comply with FEMA regulations and FDI or FII norms. Corporate guarantees require a board resolution specifying authorized officials, while personal guarantees require specific requests from individuals. The overseas guarantor or credit enhancer must satisfy the recognized lender criteria. Public sector oil marketing companies enjoy a special ECB relaxation. They may raise ECBs for working capital purposes under the automatic route from recognized lenders with a minimum average maturity period of 3 years. These entities are exempt from certain standard ECB requirements, including end-use restrictions, mandatory hedging provisions, and individual borrowing limits. However, the overall borrowing ceiling remains capped at $10 billion or its equivalent. To avail this benefit, OMCs must maintain a board-approved foreign exchange mark-to-market procedure and a prudent risk management framework. Before the exam, focus on a few high-scoring compliance points. Remember that LRN is mandatory before any drawdown. Form ECB2 must reach RBI within 7 working days from month end. Changes in ECB terms require reporting through a revised Form ECB within 7 days. Domestic parking of ECB proceeds is allowed in unencumbered term deposits for up to 12 months. Public sector OMCs enjoy a special $10 billion United States dollars ECB facility. Finally, remember the untraceable entity conditions: 2 quarters of non-responsiveness, 6 reminders, and non-submission of the auditor's certificate for 2 years or more. These are frequently tested examination areas. Welcome to this CA Final Law Masterclass on FEMA, where we will cover 2 highly important topics: external commercial borrowings for startups and the Overseas Investment Framework introduced in 2022. These provisions were designed to support global business expansion while maintaining regulatory oversight. In this session, we will understand startup ECB eligibility, recognized lenders, borrowing limits, security and hedging requirements, ECB rules for entities under investigation and insolvency proceedings, and finally, the new overseas investment regime. We will also decode important examination concepts such as control, financial commitment, ODI, OPI, strategic sectors, and key exemptions under the 2022 framework. This chapter revolves around 2 major reforms. First is the Startup ECB Framework, which provides eligible startups with a simplified route to raise overseas borrowings. Second is the Overseas Investment Framework of 2022, which replaced older regulations and was introduced to improve ease of doing business and integrate Indian businesses with global value chains. For examination purposes, pay special attention to numerical limits, such as the 3-year maturity requirement, the $3 million United States dollars borrowing cap, and the distinction between overseas direct investment and overseas portfolio investment. These concepts are repeatedly tested in CA final examinations. Under FEMA, AD Category I banks may permit eligible startups to raise ECBs under the automatic route. The startup must be officially recognized by the central government on the date the ECB is raised. An important point to remember is that startups eligible for foreign direct investment may also choose to raise borrowings under the general ECB framework instead of the special startup route. Regardless of the route chosen, startup ECBs must satisfy a minimum average maturity period, commonly called MAMP, of 3 years. This maturity requirement is a favorite examination question and should always be remembered, along with startup ECB eligibility. Not every overseas lender can provide a startup ECB. The lender must be a resident of a FATF-compliant country. However, 2 important exceptions exist. Foreign branches or subsidiaries of Indian banks and overseas entities in which the Indian entity has already made overseas direct investment cannot act as recognized lenders. Startups may borrow through conventional loans or through non-convertible, optionally convertible, or partially convertible preference shares. Another beneficial feature is that conversion of ECB into equity is freely permitted, subject to compliance with applicable foreign investment regulations governing startups. The maximum ECB that a startup can raise under this framework is $3 million United States dollars or its equivalent during a financial year. Borrowings may be denominated in foreign currency, Indian rupees, or a combination of both. Where the borrowing is in Indian rupees, the non-resident lender must arrange rupee funds through swaps or outright sale transactions routed through an AD Category I bank in India. Another noteworthy relaxation is that there is no prescribed ceiling on the all-in cost. Instead, the cost of borrowing is left to mutual agreement between the borrower and lender. Startup ECB proceeds enjoy considerable flexibility. The funds may be used for any expenditure connected with the startup's business activities. Security arrangements are also left largely to the borrower's discretion. Security may include movable assets, immovable property, intellectual property rights, patents, trademarks, and financial securities. Corporate guarantees and personal guarantees are also permitted. Additionally, startup ECBs enjoy a significant exemption because the leverage ratio and ECB liability to equity ratio requirements applicable in normal ECB cases do not apply here, making overseas borrowing much easier for emerging businesses. Although startups receive several relaxations, certain restrictions remain strict. Indian banks, all India financial institutions, and NBFCs cannot issue guarantees, standby letters of credit, letters of undertaking, or letters of comfort in connection with startup ECBs. Regarding hedging, overseas lenders providing rupee-denominated ECBs may hedge their exposure through approved derivative products with AD Category I banks or through overseas branches of Indian banks. For foreign currency borrowings, startups remain exposed to exchange rate fluctuations and are advised to maintain a robust currency risk management strategy, including natural hedges where possible. Entities facing investigations, adjudication proceedings, or appeals under FEMA are not automatically disqualified from raising ECBs. If they are otherwise eligible, they may still access ECB funding. However, they must disclose the pendency of such proceedings to the AD Category I bank, or RBI. The approving authority then forwards a copy of the approval to the concerned investigating agency. For entities undergoing restructuring, ECBs may be raised only where specifically permitted under the approved resolution plan. Importantly, the borrower remains primarily responsible for compliance, while AD banks must ensure regulatory adherence by their constituents. FEMA provides special ECB mechanisms for stressed borrowers. Eligible manufacturing and infrastructure companies, whose domestic rupee loans have become SMA2 or non-performing assets, may raise ECBs to settle those loans under a one-time settlement arrangement. Domestic lenders may also assign such loans to eligible ECB lenders, subject to compliance with maturity and cost requirements. However, foreign branches and overseas subsidiaries of Indian banks cannot participate as lenders in such cases. During corporate insolvency resolution processes under the Insolvency and Bankruptcy Code, resolution applicants may raise ECBs under the approval route to repay rupee term loans of the target company. The Overseas Investment Framework introduced in 2022 represents a major regulatory reform. It is governed by Notification GSR 646E and replaced earlier regulations governing foreign investments and overseas property acquisitions. The framework consists of FEMA Overseas Investment Rules 2022 and FEMA Overseas Investment Regulations 2022. The rules establish permissions, restrictions, pricing norms, transfers, liquidation, and restructuring provisions, while the regulations address operational matters such as reporting, debt instruments, payment methods, and compliance procedures. The overall objective was to simplify overseas investments and move several activities from the approval route to the automatic route. Among all definitions in this chapter, control is one of the most important. Control means the right to appoint a majority of directors, or the ability to influence management and policy decisions. It also includes situations where a person holds 10% or more voting rights, whether directly or indirectly. Equity capital includes equity shares, perpetual capital instruments, irredeemable instruments, and fully and compulsorily convertible non-debt instruments. Another important concept is disinvestment, which means the partial or complete extinguishment of rights, title, or ownership in equity capital previously acquired by the investor. Financial commitment represents the aggregate overseas exposure of a resident. It includes overseas direct investment, debt investments other than portfolio investments, and non-fund-based commitments such as guarantees. A foreign entity refers to an entity incorporated or registered outside India, including those established in IFSCs, generally having limited liability. However, this limited liability condition does not apply to entities operating in strategic sectors. Remember the basic formula frequently tested in exams. Overseas investment equals financial commitment plus overseas portfolio investment. Understanding this equation helps simplify the entire overseas investment framework. ODI is one of the most tested concepts in FEMA. It includes acquisition of unlisted equity capital in a foreign entity, subscription to a foreign entity's memorandum, investment of 10% or more in the paid-up equity capital of a listed foreign entity, or any investment accompanied by control even when the stake is below 10%. A very important examination point is the continuity principle. Once an investment is classified as ODI, it continues to retain that character, even if the investor's holding later falls below 10% or control is subsequently lost. Any overseas investment that does not qualify as ODI generally falls under overseas portfolio investment. OPI cannot be made in unlisted debt instruments or in securities issued by Indian residents, except where IFSC exceptions apply. Another interesting rule relates to delisting. If an investment was originally classified as OPI in a listed foreign company, it continues to be treated as OPI even after the company delists, unless further investment changes its classification. Also remember the concept of sweat equity shares issued to overseas directors or employees for know-how, intellectual property, or value additions. Strategic sectors include energy, oil, gas, coal, mineral resources, submarine cables, startups, and any other sectors notified by the central government. Foreign entities operating in these sectors enjoy exemption from the normal limited liability requirement. The overseas investment rules also do not apply to investments made by IFSC-based financial institutions, investments acquired through resident foreign currency accounts, investments funded from foreign currency resources held outside India by persons employed in India for less than 3 years, and transactions covered by Section 6(4) of FEMA. Finally, remember that RBI publishes ECB information monthly, reinforcing transparency and regulatory oversight. Not every overseas investment transaction falls within the scope of the 2022 Overseas Investment Rules. Several important exemptions exist. The framework does not apply to investments made outside India by financial institutions located in an IFSC. It also excludes acquisitions or transfers funded through resident foreign currency accounts. Another exemption covers investments made from foreign currency resources held outside India by persons employed in India for a specific assignment not exceeding 3 years. Transactions protected under Section 6(4) of FEMA, relating to assets acquired while a person was a non-resident, are also excluded. Finally, remember that RBI publishes ECB information such as borrower name, amount, purpose, and maturity on its website every month, ensuring transparency.